And good evening, everyone, and welcome. I'm Tyler Matheson in our nation's capital, where the Federal Reserve kicked off its two-day policy-setting meeting today. And tomorrow, we'll find out what the Fed says about its next moves.
And I'm Susie Garabin. On Wall Street, the focus of investors was also squarely on the central bank. The major stock averages rallied, with the Dow even reaching a record intraday high. The S&P 500 index posted its biggest gain in a month. Now, investors bought up stocks on reports that tomorrow, when the Federal Reserve policymakers wrap up their two-day policy meeting, they'll signal that they are not in a hurry to raise interest rates. With that, the Dow shot higher, closing up more than 100 points. The Nasdaq rose about 34 points, and the S&P was up by nearly 15 points. We have two reports on this Fed-fueled rally, starting with Mary Thompson on the reaction at the New York Stock Exchange, and Steve Leisman with a look ahead at exactly what investors are hoping to hear from the Fed.
A near miss for the Dow Jones Industrial Average as the blue chip index hit an intraday all-time high, but failed to close at a record. After muddling along in the morning, the markets took off right before noon on a report that said the Federal Reserve is unlikely to make any major changes to its outlook for interest rates when it concludes a two-day policy-making meeting on Wednesday. This ignited the markets, along with a report that China looked to juice its economy, with the central bank injecting stimulus into the nation's largest banks. Energy stocks were also a factor in Tuesday's rally, leading the way higher for the markets. Energy stocks responding to an increase in oil prices. Oil prices rising on reports that OPEC is likely to cut production when the cartel meets in November. At the New York Stock Exchange, I'm Mary Thompson for Nightly Business Report.
The Fed is in play, with markets ready to slice, dice, and otherwise scrutinize tomorrow's policy statement for any hints about the central bank's plans to raise interest rates. Two phrases will get particular attention. The first says there is significant labor market underutilization, and there's speculation the word significant could be dropped. That could be a hint rate hikes are nearer, since it suggests the Fed thinks the job market is healthier. The second says it will be a, quote, considerable time between the end of bond buying under quantitative easing and when interest rates rise. Some have suggested the phrase could be dropped, as the Fed wants to be more dependent on the economic data rather than dates. But dropping the phrase could be a suggestion to markets of a possible earlier rate increase.
I think they're going to remove considerable time. I think there will be a bump on Wednesday when that happens. Remember, if you take a look at the Fed funds futures market, they are below the rates that the FOMC members believe are going to prevail at the end of 2015 and 16.
Markets are, to some extent, already planning on an earlier appointment with higher rates. The CNBC Fed survey showed the 37 economists, strategists, and fund managers polled see the first rate hike coming in June 2015. The second survey in a row that they've brought nearer the date for the first hike. And they see the Fed hitting somewhat higher rates in 2015 and 16 than the prior survey. Whatever the outcome, it seems that the market has faith in new Fed Chair Janet Yellen. 44% think the Fed can exit its easy monetary policy of the past several years smoothly. That's up 10 points from the last poll. Just 17% believe it will end badly with a recession or a stock market crash, half the results from the prior survey. And the Fed under Yellen is getting high marks for being clear and credible, even better marks than her predecessor, Ben Bernanke. Will it last? Yellen has a tough road to negotiate in the next several months if she is in fact going to hike interest rates for the first time in 8 years, and she'll need every bit of market faith she can gain to be successful. For Nightly Business Report, I'm Steve Leisman.
And Jared Bernstein joins us now to talk more about the Fed. Jared is an economist at the Center on Budget and Policy Priorities and former chief economist and economic policy advisor to Vice President Joe Biden. Jared, good to see you again. Is the economy, in your view, strong enough for the Fed to stop buying bonds and start raising interest rates?
Well, perhaps yes on the former, but definitely no on the latter. I think that the tapering off of the bond buying program, and we should get to the end of that tether probably at the next meeting in later October, has been going along steadily and hasn't shaken the economy up much at all. However, it is too soon to raise interest rates. So the discussion is, well, when will it be the right time? Janet Yellen is certainly not giving up on a labor market that she still believes is too slack.
Do you think, well, let me ask you this. What would it take for you to say, go ahead, raise my rates?
I would like to see that the unemployment rate come down well within the Fed's full employment range, which is below 5.5%, and not because the labor force has declined, but because people left unemployment to get jobs. I'd also, and by the way, here I really am parroting Janet Yellen, who's expressed great concern about the long-term unemployed. I'd like to see that long-term unemployment rate come down. That's been historically elevated now for years.
So you'd much prefer, as Steve Leisman just said, for the Fed to become more data dependent rather than time dependent. Do you think the data will drive the Fed to raise interest rates in, say, 6 to 9 months? Will we be there then?
Well, look, when you talk about the Fed, you're talking about a lot of different people, but I do think the people who I don't want to say matter the most, certainly Janet Yellen, are much more data dependent than time dependent. And I think it is a matter of not just the labor market in terms of what economists call the quantities, jobs, unemployment, long-term unemployment, wages. I think Chair Yellen very reasonably wants to see some wage pressure in the economy, which has been lacking now for years before she starts talking about tightening.
Now, you've said what you would prefer to see the Fed do. What do you think they will say and do tomorrow? Are you in the camp that says they will drop those two magic words, considerable time or a significant...
I am in the camp that says they will not. And here's my reasoning. I don't think the Fed likes to have its forward guidance pushed around by outsiders. When you think about it, this take the considerable time, those two words, take that out of the statement, that's really come from people outside the Fed who pick up something more hawkish going on, and they've kind of created this buzz. I think this Fed has shown before, and under Bernanke as well, that they don't like to be moved in terms of forward guidance by kind of the chattering classes outside. So I expect them to kind of put their foot down and say, we'll let you know when it's time for us to change forward guidance.
Very quickly, what was the stock market saying, if anything, today about the Federal Reserve? Has it already priced in whatever they think the Fed can do? Because we had an intraday high.
Yes, I think that's probably part of the solution, but part of the reason. But I do think that, in fact, if the Fed takes the more kind of dovish, data-dependent tone that I think and hope they will, that the market actually might get a bit of a bounce tomorrow. It could go either way, but I think the expectation is for the Fed to be more hawkish, to tighten. If the market doesn't see that, I suspect you might see a bit of an uptick.
All right, Jared, thank you very much. Jared Bernstein of the Center for Budget and Policy Priorities.